Welcome back. You're still watching Trading Hour on CNBC TV18, and let's get chatting about a result now. Cigniti Technologies is on our radar on the back of its Q4 numbers. The company posted a 5% sequential growth in revenue, while EBITDA and profit came under pressure. To discuss the quarter gone by as well as the outlook, Krishnan Venkatachary, Chief Financial Officer of Cigniti Technologies, joins us on the show now. Mr. Venkatachary, good morning. Thanks a lot for joining us. This is Pavitra. I have to begin by asking about the margin pressure. We have seen it down to around 10%, 9.5% this quarter versus around 12% that we saw last quarter. Even if I look at it on a full year basis for FY22, it's closer to around 10%, and compared to the kinds that you used to see of around 15, 16%. Can you tell us what is happening on that front, and do you expect to go back to that 16% kind of level?
Good morning, and thanks for the opportunity, Pavitra. The quarter has seen some pressure on the margin front, but I think we are conscious of the fact that there has been, I think it's a universal phenomena in terms of the labor turnover, where we need to go ahead and do some corrections out on that front. And second thing is that we have been on a growth phase in the current year in terms of accelerating our revenues. And it was necessitated that these investments were needed for the purpose of marketing dollars to really accelerate and stabilize the engine on our $500 million growth journey. On a comparable basis, if you look at it on last year to this year, I think it will be more identical to normalize the last year EBITDA, which will be from 16 at about close to 15% or so on account of the salary optimization and cost optimization due to COVID, which was there in the last year. But I think in the current year, we have reverted that back, and then the spending has been a bit liberal in terms of trying to accelerate for the business. And the last 18 months of investments have already yielded us at about a 38% growth in terms of top line. And on removing the one-time expenditure, we would have been there at about 11.5%. So net, when I talk about a 4% reduction, I think necessitated by about a percentage of one-time cost, which will get reversed in the current year, which will not get repeated. There is a 2% investment in terms of investing in Center of Excellence and sales and marketing expenses, which is necessitated for our transformational growth, and 1% in terms of retaining the people, which we expect to bounce back in the current year reasonably. While we are not in the process of giving any guidance, I think we are quite confident and optimistic that we'll be able to reasonably bounce back in the current.
So give and take, sir, what could be the margins in FY23, and what about the top line growth?
I think you have seen over the last, I would like to step back a bit and then talk to you about 2017 to 20. At an average, we have been growing at about 8%. We just tightened the engine in terms of trying to accelerate, to have a sustainable growth in terms of maintaining the EBITDAs at about 15% levels and to move up. And when the COVID stuck in very clearly, it really gave a food for thought that we need to really stabilize the business in terms of trying to rebalance the portfolio, rebalance it with more in terms of a digital transformation company, digital service offering company, and also into newer verticals. I think that made us very clear that we need to invest back and start moving up. So we just thought that we will compromise the margin and go for an accelerated growth to see how the engine fires out. I think it has fired in all cylinders very clearly. So when you come back to the question in terms of the next couple of years in our journey, I think organically we are looking at a high double-digit growth clearly and stabilizing our margins.
Okay, all right. Mr. Venkatachary, you briefly mentioned that your goal is to get to $500 million in revenues in the next few years. So which year will you be going towards this number? If you could give us, you've given us a target. What about the timeline? Which fiscal year do you hit that? And also out of that, how much of it will be organic? How much of it will be inorganic? If it's inorganic, how much of money do you have in your books? Go ahead.
Okay. I think it's a good question. So we have laid out a plan, and we have made it very clear from 2021 April onwards, 5 years time will be a $500 million company clearly. So the timeline is very clear on that, and we are working on that. We are trying to see that how best we can accelerate. If you look at it in terms of specifically organic and inorganic, I think the efforts on the organic side, for example, to give for this year, we would have grown at about 20% is what is the targeted growth in terms of 20-25% on the organic side, and the rest through inorganic. But I think the valuations being on the northern side, clearly we said that we'll accelerate the engine and get it out on the organic side itself. So if you just go by the book in terms of the blueprint very clearly, I think we have considered in the 500 million journey about close to 22% coming out from the inorganic growth and the rest coming from the organic growth, clearly. But I think there's no hard and fast rule. When we see some kind of an interesting inorganic growth, which could be of good volume and a good value fit to us, clearly, why not? I think in terms of the cash in the books, very clearly, today, as it stands, we are having about close to 210 crores of cash, which is with us. And we are also confident of leveraging the further cash flows, which is going to be taken out. Yeah.
Okay, so of this 210 crores of cash in your books, how much have you earmarked for a buyback and how much for an acquisition?
Buyback is an excellent question, because that is up to the board to decide on 18th. I think it comes under the rule in terms of the automatic approval and what the board decides. So I would like to reserve my comments on the buyback very clearly. But I think we also have estimated some reasonable sum in terms of the buyback to say very clearly to the investors and also out to the world out there that the management is confident about the company. The company is confident that it is at this stage, at these valuations, definitely the company feels that it is worth buying its shares. But I think it's subject to the board and subject to the regulatory approvals. And I would like to leave that comment out. But we have enough of cash flows apportioned that out.
So just to go back to the point, by FY26, you will be at $500 million in terms of revenues, right?
Absolutely.
Okay.
Absolutely.
Okay, got that. And you're also talking about buyback. Business is sounding fairly confident. I'm just looking at the promoter holding. It was at around 37%. It's come down to around 33.9%. Could you explain that to us? Why? I mean, have you issued some shares, some warrants, or have the promoters sold in the open market? Give us some clarity on that front.
Oh, it is not selling in the open market. Invariably, promoter in the last year has also acquired about a percentage or so, a fractional, little less than a percentage. There are some amount of natural dilution on account of ESOP being issued out, and then there has been a specific instance in terms of on his personal account in terms of settlement of certain loans. Probably some amount of shares have been diluted out in the to a specific third party. But if you look at it, probably I would put it this way clearly, is that the promoter's interest in terms of trying to move ahead and acquire also is quite high. While it is so, but I think we are more, if you look at it in terms of where we are, I think the company is run completely by a set of professional board and professional set of management team.
Okay.
So it doesn't really matter in terms of how the promoters are going to really hold out or whatever it is.
No, it does matter, sir. You know, sir, I mean, I think I would not agree on that, because shareholders, they normally like when the promoter entity holds a larger part of shares. In this case, if they believe that, you know, they have some personal needs, then it's fine. But normally it's always good when the promoter holds.
Absolutely. I have a point to say that in the current day world, where you look at it, if you look at it on the technology company, people look at promoter having a wider holding very clearly, in the sense, wider set of investors holding and promoter not concentrating it out, so that there's a set of professionals who can come in and start moving up the value chain. I think that is what the company is trying to do. While there could be one of instance promoter trying to get that down, but I think that's a value chain. And if you look at it, there are few promoters who have reclassified themselves as non-promoter, who are still with us, basically holding less than 10%, still that counts to close to about 51%.
Got it. Any institutional interest? Because there's no institutional holding as of now. Very, very small FI holding is what is there.
I think probably in terms of its discovery, probably these things should happen, because we are invariably reaching out and demonstrating our capabilities. I think as we are more into our digital foray basically journey, I think the value unlock will happen, and we will see more investors coming in. Yeah.
Thank you very much for joining in. That's the word coming in from Cigniti Technology. The company saying that in FY22, they compromised on margins to accelerate their growth, which is why in FY22 they saw revenue growth of 38%. But going ahead, their aim is to see a high double-digit growth in the top line, with margins being stable. And their aspiration is that the company will be a $500 million company by April of 2026. That is 5 years from April 21, when they had set out that 5-year vision. But let's talk about the market technicals. Such a strong day, right?
It is.